Well, good morning, friends. Jayendra Rana here. So, topic of the day is Insuring India by 2047. Insuring India by 2047. The Insurance Regulatory and Development Authority of India has committed to enable insurance for all by 2047, where every citizen has an appropriate life, health, and property insurance, and every enterprise is supported by appropriate insurance solutions, and also to make Indian insurance sector globally attractive. So to attain this objective, efforts are being made towards creating a progressive, supportive, facilitative, and a forward-looking regulatory architecture to foster a conducive and competitive environment leading to wider choice, accessibility, and affordability to policyholders. This reform agenda taken up by IRDAI drives inspiration from the Government of India's vision of financial inclusion and a strong emphasis on accelerating reforms. So the focus of IRDAI is to strengthen the three pillars of the entire insurance ecosystem, with insurance customers, that is policyholders, insurance providers, means insurers, and insurance distribution or distributors, means intermediaries. So by making available right products to right customers, creating robust grievance redressal mechanism, facilitating ease of doing business in the insurance sector, ensuring the regulatory architecture is aligned with the market dynamics, boosting innovation, competition, and distribution efficiencies while mainstreaming technologies and moving towards principle-based regulatory regime. Towards this objective, amendment to various regulations were proposed and were placed for stakeholders' comments. So this was followed by a series of discussions and interactions with insurers, intermediaries, including individuals, agents, corporate agents, broker, insurance marketing firms, and experts. So a careful evaluation of comments and suggestions was carried out. The amendments to regulations were also placed before the Insurance Advisory Committee, an advisory committee for consultation formed under the IRDA Act 1999. So the revisions are aimed at enhancing flexibility and autonomy to the board in the operational and financial decisions. For expenses of management, various segments caps are proposed to be replaced with a single overall limit in general and health insurance. So for life insurance, the segment limits of expenses are certain segments are proposed to be enhanced with overall regulatory environment at the company level. For commissions, the maximum limits as specified in the certain regulations, current regulations, are proposed to be removed, with commissions being linked to the overall limit of expenses of management. But this will enable insurers to devise commission structures incentivizing the intermediaries in line with their solicitation efforts and also making insurance more affordable. So amendments to regulations follow a consultative process. Then IRDAI's mission of protection of policyholders' interest and orderly growth of the insurance sector is always a priority Efforts are made to reach the last mile of strengthening the entire ecosystem. A periodic review of the regulatory framework will be a continuous exercise to ensure that it is in sync with the emerging trends and dynamics of market and serves the intended objectives of insurance for all by 2047. So IRDI rules on long-term planning, because with the planning this would be made easy, and in this direction certain steps are taken by the insurance regulator. Say for example, one license for all insurance. The government is likely to introduce the Insurance Laws Amendment Bill 2022, which will pave the way for issuance of composite license for insurers. A composite license which will allow insurers to undertake general and health insurance via a license via a single entity has been a key industry demand. The aim is to bring the legislation in the budget session. The Finance Ministry invited comments on amendments proposed to the Insurance Act 1938 and the IRD Act 1999. So the proposed amendments primarily focus on enhancing the financial security of the policyholders, promoting the policyholders' interest, improving returns to the policyholders, and facilitating the entry of more players in the insurance market, leading to economic growth and employment generation. So the ministry said, while seeking comments from all stakeholders, the bill proposes to remove the 100 crore minimum paid up equity capital requirement for carrying out life, general and health insurance business as part of a significant revamp of insurance framework. So the aim is to enhance efficiencies of the insurance industry, operational as well as financial, and enable ease of doing business. Other regulatory reforms are that private equity funds can now directly invest in insurance companies. Investments through special purpose vehicle has been made optional. Further, a single investor with 25% in equity will be classified as investor, and any investment more than only one will make for promoter as against 10%. So insurance company registration regulations are also simplified. The IRDA has published on its website to the new registration of Indian Insurance Companies Regulation 2022 to promote growth of insurance sector by simplifying the process of registration of Indian insurance companies and to promote ease of doing business. So the new regulations to take effect after they are published in the official gazette cover matters such as permissible classes of insurance business, procedures for registration of an insurance company, commencement of insurance business, fit and proper criteria for the license applicant, promoter and investors, investments in insurance companies as promoter or investor, investment by private equity funds, and the lock-in period on investments in insurers. Each corporate agent can now market product of up to 27 insurers. So this is also a special effort by the insurance regulator. A corporate agent may now be associated with up to 27 insurers, that is 9 each in 3 branches. These are life, health and general insurance companies. So this follows new rules notified by the IRDI that previously allowed incorporated agents to market the products of one insurer from each of the 3 branches. The goal is to increase insurance penetration in the country. More banks are corporate agents and represents a wide and varied segment of customers including retail and corporate. So, opening up to 9 insurers is particularly relevant in general insurance as the number of insurance products is high, and there are only some insurers who specialize in certain categories of insurance products. So, this further increases choice. However, the restriction on corporate agents in marketing retail and commercial lines of general insurance products for a sum assured not exceeding Indian national rupees 50 million, that is $606 lakh per risk continues. So for insurance marketing firms, besides increasing the number of tie-ups from 2 insurers to 6 in each class of insurance business, the area of operation has been expanded to the state level from the district level. Insurance marketing firms are now allowed to operate in all districts of a state allotted to them. This increases the width as well as the depth of operation of insurance marketing firms in the designated state and will support the cause of depending or deepening insurance penetration. So the industry observers say that for insurers, the new rules mean that they do not have to pay huge sign-in bonuses to banks to act as their corporate agents. Previously, when the banks were allowed to distribute the products of only one insurer and a particular branch, insurance companies paid big sign-up bonuses to the banks. Thank you. Thank you very much.